Alright, well, hello there everybody. This is a class on the credit spread placed with a 50 IV rank or higher. So, again, as you guys know, Tasty Trade advertises that this is an excellent way to trade your credit spreads as well as other trades, and they're always suggesting that if you enter into selling premium when your rank is 50 or higher, then your odds are incredibly increased and so on. So I just ran a quick test out of curiosity, a query to see how the 50 rank or higher credit spread on the put side would actually perform. And I selected 6 different products to trade that are really common and have high volume. And then they advertise that you should do this on multiple assets for diversification and to increase the number of, or the law of numbers, so that you get the true probability. And then they also teach that you don't need to manage the trades and that you just put them on and let them go. And supposedly it's a magical trading system. So this is what I call a pasty trader. Found this image. Kind of like that one. Like the colors. So here's the 10-year backtest, again, to save you guys time, but you can certainly work on it yourself. But I ran the query, so it wasn't didn't take as long. And the formula that I checked, again, is a very common credit spread. So we sold here at the 10 or negative 10 delta, and then the bought around the 5 delta to create a vertical spread. And then I use this set it and forget it trading method that they suggest works. And then I started with $10,000 allocated to each one of these products. We compounded the returns because, again, if you use a fixed 10,000, then that means you have almost unlimited risk, because you have to constantly size up every allocated a part of your portfolio as you lose. So that wouldn't work because in 2008 most of these were decimated to nothing, so there's no way to really keep sizing up every account. So that's another thing that they suggest people do is allocate 10,000 every time to these trades, but that only works if you're using a very small portion of your account, because you have to constantly size up as they lose. So anyway, I just allocated $10,000 and that was it. And then as they made money, then they were able to produce more returns, but then as they lost money, then the losses were limited, and then that's just how it is. 10,000 for each trade. So here's the 6 that I found. So again, I used a website and what was it, FinViz, and did a filter and chose these symbols again to be diversified. Apple lost the entire 10,000. Well, it had $11 left after the test. It was also a 10-year test. So I did 2005 to 2015. If it was able to do the whole span, it would actually be a 16 complete years, minus like a few days. But anyway, so in 2008, the Apple allocated money was reduced to $152. And then those following years, it never even made it back to 200. Then finally it got down to $11, so the test just ended. Okay. The second test was IWM, This one in 2008, this one was reduced all the way down to $870. And then by 2015, it never recuperated, and it finished at $728 for a total loss of the 93%. Okay, so again, just the first two here, you can see by the time they reached just a couple years into the trades, 2008, they were both just demolished. And so again, if you're trying to diversify and choose 10 or 20 of these, then in most cases, it doesn't really help to diversify, because now what you have is just a big bucket of trades that they're all gonna go underwater, and then you have a big mess because it's really hard to manage them all. And then again, if you were using their method where you keep replenishing the 10,000 every month, these were 30-day trades, by the way, then they would have lost much more than 10,000. And then again, if you have to keep 90% of your money in cash to replenish, then that system doesn't work either, because you're not investing any of your money. Test number 3 was Microsoft. This one just pretty much lost every year, and then it finished at 1150 out of the 10,000. The test number 4 were the Qs, and lost the entire thing, left with $14 after the test. In 2006, started off really bad. The 10,000 was reduced to $27.26. In 2008, down to $14. So we ended that test. SPX, again, lost the entire thing. 2008, it was reduced to $74. And then by 2015, it was down to $8. And Walmart, this was the best performing, only losing 74%. 2007, it lost 37%. It lost 39%. 2012, 46%. In 2014, 72% in 2015. So, again, all of these, remember, well, these were all 30-day trades, 10 deltas, credit spreads, and the requirement was the IV rank had to be 50 or higher. So that's about it for this class. I just wanted to quickly go over some of those tests and validate their claims that you can simply choose your credit spreads with a IVR of 50 or higher and then not manage them. So there's some results for you. There's obviously a lot of different symbols that you can do, but the ones that I found there did not work. Anyway, the main point is just be very careful if you're trading credit spreads, because I know that some of the clients probably still do them, and don't rely on the IV rank only. You certainly have to implement some form of risk management, but that idea doesn't look like it's the answer.